Well, we believe tapering by itself is largely in the price. Short of a very significant shift in data, it's likely the Fed will continue to taper and end its QE program. But for us, the next logical step is the market begin to question when and if the Fed is likely to begin raising interest rates. And to us, that is what is likely to impact the commodity markets. Again, a continued recovery means that that's likely to be negative for gold in particular. If interest rates are likely to rise, that ultimately raises the opportunity cost of holding gold, which yields you nothing. Higher interest rates are positive for the dollar, which again are a negative for gold. So we're still bearish on gold. I think in energy prices, it's slightly different. I mean, energy prices have remained largely within a range. We expect that to continue, but there's more the geopolitical premium that's changing, less so a function of what's happening on US Fed policy. Well, eventually, yes. I mean, we've had quite a few distortions in many emerging markets because of this excessive, global liquidity. So eventually, it does lead to a more sort of, normalized environment, so to speak. But having said that, the key risk for India as well as other emerging markets ultimately is what happens at the point when the US interest rate cycle turns. Historically, that has tended to place pressure on flows to emerging markets, and we've often seen reversals away from emerging markets to the US. And the reason to believe that there are some parts of the emerging world, such as Turkey, which do face a lot of risks. I mean, they do face a lot of classic textbook weaknesses. So the risk for India is that it doesn't escape that completely. I mean, India does still run a current account deficit, even though it is much better than where we were before. So there may be some volatility spillover, both in the equity and bond markets. But again, the fact that the currency is weakened in the past, the fact that external balance have improved are positives. In the short term, 59 is possible. It's really not very far away from where we are today. But I think the risks do still stem from the current account deficit. I mean, if you think about the recent improvement, there has been improvement, but a lot of this has come from both a reduction in gold imports because of restrictions in place, and the fact that energy import growth has slowed because the economy has been slow. So clearly, one of the risks faced is that as the economy does eventually re-accelerate, you may begin to see this deficit widen. And if that occurs at a point where there are risks elsewhere in the emerging market world, even if they are in emerging Europe or Latin America, the fact is there is a risk you can have some spillover. So I'm sort of reluctant to say that we've seen the end of rupee weakness. I don't think that risk has gone away, but that is something which we think will come through later in the year. In the short term, there's like I said, 59 is not very far away from where we are.